Hi, everyone. This is Jason Barack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. I found his work a few months ago. He's done a lot of extensive interviews on Blockworks Macro. He's a very good follow over on financial Twitter. He's the co-founder, CEO, and chief investment officer of Unlimited Funds. He has a number of exchange traded funds for people to go out and buy. I think they're with hedge funds. So for the average retail investor who doesn't have exposure to hedge funds, they can get that. He has built innovative hedge fund strategies for more than 2 decades. He worked at Bridgewater Associates with Ray Dalio, where he was a member of the investment committee and developed strategies across different asset classes. And he's also authored hundreds of Bridgewater's widely read daily observations. Bob Elliott, thank you for joining me.
Thanks so much for having me.
So Bob, we're recording this interview on June 5th. 2024, the 10-year US Treasury yield, it's back down to 4.289%. It's just been wild swings of volatility. I want to ask you, though, about the swings in the volatility for the 10-year US Treasury. Have you seen volatility swings like this before in such a short period of time, given like the last 3 to 5 months?
Well, I think most of us in our professional careers have, the bond market has mostly been an afterthought rather than the primary driver of global asset returns. But as inflation in the U.S. has become became more of a concern, and the Fed's response to it has become more uncertain, shifts in the bond market, particularly connected to shifts in the expectations of the Fed's actions, have become an increasing driver across asset markets. And today, and really for the last couple of months, the bond market, the U.S. bond market, has basically driven every major asset class globally. As yields rose, they sold off, and as yields have come in, most of those asset markets could make new highs.
So you would guess then, or like probability, that one of the major indicators people should watch is the yield on the 10-year US Treasury, whether it goes above 4.7% and stays there, or it's coming back down like it is in the last week.
Yeah, that's right. I mean, the bond market holds the key, and I think important to connect that to is not just the bond market, not just the long end. What's driving the long end right now is what's going on in the short end, and what's going on in the short end is determined by whether the Fed chooses to ease or not in line with folks' expectations. And so, all eyes are on the Fed in terms of driving the long end and then cross asset market performance.
But the 10-year US Treasury, wouldn't you say that that's more important for the private sector? Because a lot of people, a lot of businesses or investors, they do discounted cash flow modeling, and a lot of discounted cash flow modeling, it's only good for 9 or 10 years then.
Yeah, that's true. Although the bonds discount rates are in public market stocks. Public market stocks have something like 15 years of duration, and so often growth expectations move counter to bonds, move counter in bonds and stocks. But we've had an interesting set, and that was really the case in the first couple of months of the year, right, when people came into the start of 2024 worried about whether U.S. growth would slow meaningfully. That didn't come to fruition, reset their growth expectations, and what we saw is stocks rally and bonds sell off. What's interesting in the last couple of months is now that growth expectations in the U.S. have reached relatively high levels. Expectations are for 3% real growth through the end of the year. At this point, those can't really press much higher. And so actually what's driving most of the volatility of equity prices is how the bond market is moving. As yields rise, stocks sell off, and as yields fall, stocks rally. They're very connected to each other in a way that where the bond market is really determining what's happening in the stock market, and that's because growth expectations are already so elevated.
Do you also think that the yields on the long-term bonds, the 10 years Treasury or longer, it has more to do with the small caps? So the small caps, a lot of them use debt for growth. So if the rates keep rising, then the small caps can't get financing or can't use any debt for growth.
Yeah, many of those small caps are significant loss-making companies. Something like 30 or 40% have negative EBITDA on an ongoing basis in the Russell 2K, and so monetary policy conditions are critically important to whether or not they're going to be able to get the incremental capital they need to be a going concern. And so that's why you see that high sensitivity, which is that the long end of the yield curve in the U.S. bond market is reflective of shifts in expectations of U.S. monetary policy, and so too are how Russell 2K or small caps are trading at this point.
Do you agree with James Grant of Grant's Interest Rate Observer that after the 40-year bond bull market, with yields generally coming down, that things have switched to a long-term secular bond bear market now?
I love Jim Grant, and for those of you who haven't gotten a chance to read his regular publications, absolutely a great read. And my views largely align with how he's showing them there. I mean, I think the basic issue is that the last 40 years was really a bet on disinflation and peace. And that was, critically and a central bank, the Fed, with a lot of credibility in terms of maintaining its 2% inflation target or below. Those three things on a forward-looking basis don't look necessarily like they're going to continue. Disinflation, which was built on, global integration and globalization, is likely to reverse as those as the world becomes less integrated. The peace dividend, particularly as it relates to commodity prices, looks more behind us than ahead of us. And the Fed at this point has missed its inflation target for what? If you look at their SEP, they say they're going to miss it for another, for 5 years in total, which certainly, any reasonable person would start to raise a question about whether they're really committed to the 2% target, given the persistent missing of it in the last few years. And so, you add those three things up, and it certainly doesn't look like we're in a position to have that secular bull market that we saw for so many years continue into the future.
Yeah, I think two of the major themes that also brought yields down and kept costs relatively in check were the offshoring or outsourcing of a lot of factory jobs to China for cheaper labor, cheaper cost of goods sold. So that was a long-term trend for decades. And then also the internet and web-based businesses. A lot of businesses could save money, just setting up a warehouse and selling online, and that cut costs too. But eventually you run out or costs start to rise again.
Yeah, that's exactly right. I mean, we are in the fracturing of those global supply chains as a function of increased conflict, cross-border conflict, combined with, we went coming into COVID basically as short a just-in-time delivery supply chain setup as you possibly could have. And obviously there was, we learned about the lack of robustness of such a supply chain during the COVID period. And so the building of parallel supply chains and multiple supply chains, just by their nature, are inflationary. And it doesn't mean it's a bad idea. And particularly there's certain supply chains which are important from a geopolitical or geostrategic reason. But whether it's a good idea along that basis or not, it is certainly inflationary to duplicate supply chains.
So on a transition now to the comments that David Einhorn has made about how market structure with stocks, he basically called them broken and things have changed a lot in the last 15 or 20 years with passive investing or index funds. Do you think that the stock market, there's a permanent bid under it now because of people who in their retirement accounts are basically just dollar cost averaging with their savings if they have like a corporate job that's high paying with these index funds?
Well, we've had a big transition from defined benefit plans to defined contribution plans in terms of structural retirement savings. And it's not clear to me that there's a huge difference in terms of sort of the persistent bid that exists in the defined contribution plan system relative to what existed previously. Pension funds bought stocks and bonds, for decades, just as people are buying them in their 401k. And so, is it possible that is creating, is that creating a bid under the market? Yeah, to some extent it is, but I certainly, the statement that the markets are broken doesn't align with certainly what I see when it comes to seeing that markets are largely trading in line with the type of macroeconomic dynamics that have existed for multiple decades. It doesn't mean that they're right or the consensus expectation is, where I think markets will go, or that there's no alpha. It just means that the basic day-to-day market behavior still looks pretty normal to me.
You don't think it's weird though that a lot of these index funds, they end up owning over 40% of the shares outstanding, and so they're not like being activist investors getting board seats or actively trying to manage the operational controls of the company, profit margins, things like that. They just passively own a lot of shares, and then they're controlling over 40%, 50% of the shares of these stocks. The other issue I have with the index funds is the market cap weighting. It just seems that money indiscriminately goes into the companies that are already big. It's not reallocating capital like an active money manager like you or others, where they would try to buy low and sell high. It just keeps going into the larger and larger market caps.
Yeah, but people have always invested in index products in one form or another. I mean, in index futures or the equivalent. When it comes to oversight, I mean, my view has always been that behavior by boards and shareholders and things like that is not a meaningful influence on corporate outcomes. I mean, part of that is being a macro investor, and so seeing the world through that macro lens and seeing that the much bigger driver, certainly as you start to think about stock indices, stocks in index form, maybe any individual stock could be on the margin, but at an index level, macroeconomic drivers matter a whole heck of a lot more than any individual decisions that are being made by companies themselves or their boards or oversight related to it.
So in terms of your macroeconomic views, do you think that a lot of other countries outside the US are already in a recession?
I mean, the rest of the world, what I'd say is that the rest of the world is soft. Not quite weak enough to probably define it as a recession, sort of as we traditionally think about it. Part of the reason why that is that that the demographic circumstances are such that you don't really need much growth in order to keep labor markets tight. So, as an example, if you look at Europe, growth. The Eurozone, growth is, very modestly above zero, but the unemployment rate is at secular lows. The same is basically true in the UK. And so while those economies feel like they're growing slowly, they are not nearly as weak given their underlying long-term trend potential than might be apparent. And that's changed a lot. Like even in the US case, what was potential or trend growth in the US, 20 years ago, 20, 25 years ago was, 2 to 3%. And today is, much closer to 1%, 1 to 2% to keep labor markets tight. So that's a big difference. And you have to really reframe your perspective on it, given those demographic shifts. The places that are notably weak is, Japan is notably weak with negative GDP growth, a couple of negative GDP growth prints. Canada is weak with near zero or slightly above zero growth in an environment where they have relatively significant labor force growth. And of course, China has been stagnant for multiple years.
You also have a lot of other currencies weak against the dollar. The dollar index has been relatively strong. It's at 104.30 when we're recording this interview. But you have a lot of other currencies, I would say, that are very, very weak against the dollar, especially like the Japanese yen. But there's a lot of emerging market currencies the last 6 months that have been very weak against the dollar, too.
Yeah, well, I think that really highlights the divergence of what's going on economically. I mean, look, the U.S. is outperforming essentially every other major developed economy. And as a function of that is in a position where the U.S. needs to maintain tighter monetary policy for an extended period of time relative to places, place like Japan, which, has inflation that's below their target, back below their target, and negative GDP growth, which is likely going to have, very weak growth for, very weak or stimulative monetary policy for an extended period of time. So those circumstances are firmly in place and are putting pressure on exchange rates, mostly for the dollar to be stronger relative to the rest of the world. And from the U.S. perspective, there's not really much consequence of a strong dollar. On the margin, it's detrimental to exports, but that is a very marginal effect. If you're sitting in the Fed shoes, it doesn't really matter if the dollar continues to strengthen because U.S. monetary policy remains tight relative to the rest of the world. Domestic economic strength and the need to have tight monetary policy continue matters a lot more than any impact from the dollar.
Do you think that these other foreign central banks, are they worried about the dollar rallying because they have dollar denominated debt and they have a lot of domestic inflation if their currency is getting weak?
Well, I think there's a big difference between how different economies are looking at it. If you're Japan, where you have very minimal foreign currency debt, the decline in the currency isn't really a structural problem. On the margin, is actually supporting what would otherwise be inflation that's too low. And so it's not clear. There's obviously financial stability concerns, and you don't want your currency to be plunging, and so that's why they intervene every once in a while to sort of take out specs who are over levered in short positions. But the BOJ is fine with currency depreciation. If anything, probably pleased a bit with it. I'd put that in contrast with what we're seeing out of the PBOC, where China has some dollar-denominated debt. That's not really the big problem. The big problem for China is that there is significant desire to save in dollars and real channels to be able to do it, given the amount of trade that's going on. And so households and corporations are really desperate to move money offshore in one form or another, which is putting pressure on their currency. With everyone recognizing that China needs much more stimulative monetary policy to even get relatively acceptable economic growth ahead. And so, people are figuring out ways to prepare for negative pressure on the exchange rate. And the PBOC is playing a bit of whack-a-mole to try and slow that down. And they're not doing it so successfully. They've had to intervene massively in order to just keep the currency where it is today.
And this rally in Chinese stocks the last 6 weeks, give or take, it's been mostly from foreign investors, private equity funds, hedge funds, a lot of foreign institutional investors going in there, a lot of domestic Chinese retail investors and institutional investors in China. There's been articles coming out for 6 months now saying, like you said, that they wanted to diversify out of China, get away from the capital controls. And so they were buying a lot of Mag 7. I think at one point they were paying over a 30% premium to net asset value for a closed-end fund for Chinese investors to get access to Mag 7, and the demand for Bitcoin, gold, and silver in mainland China is soaring.
Yeah, I mean, I've noticed it from the gold market, where the Chinese bid has been, basically the primary global incremental driver of gold demand over the course of the last couple of months. I think it's particularly interesting when you look at what's been going on with let's say broad China and Chinese related stocks, where a lot of there was the steps taken by the government to sort of slow what was a concerning plunge that occurred. But most of the rally that we've seen outside of that one particular point is in offshore Chinese stocks, as you say, basically with U.S. based investors who are and foreign investors who are buying. And that's really petered out. Onshore Chinese stocks have basically traded flat since March 12th, or flat since then. So it's certainly not. It certainly doesn't look like, people talked about China. This is the moment that China is now reaccelerating. And if you look at economic indications as well as asset market indications, None of those align with that. Like China continues to disappoint Western investors who keep thinking that this is going to be the point of the turn or the boom. And instead, the reality is, frankly, not much is changing in China. It's unusual because typically in a market-based system, you would expect the central bank to take more aggressive steps to stimulate the economy and improve domestic demand. I think what it highlights is there are issues and matters that are political in nature that are driving the decision-making process, which are inconsistent with market-based, macroeconomic thinking. And so you just want to be careful about how confident you can be in any trade across Chinese markets, given that there are non-economic reasons that are driving policy and market action.
Yeah, I think that stock market rally in China is going to peter out. I don't know exactly when. I think you said it's already started to lose its steam, but the demand for Chinese stocks wasn't from domestic Chinese investors, either retail investors or institutional investors. The major issue I see there is their housing bubble with real estate prices falling. And then they just had the largest amount of cash withdrawal from Chinese banks in April. So that to me says that a lot of people inside China are not confident in their domestic economy and their stock market, and they're hedging a potential yuan devaluation. So they're trying to hedge with gold, silver, Bitcoin, and not as confident with Chinese stocks and Chinese real estate.
Yeah, I mean, if you're a Chinese-based investor, like what looks good? The stock market is basically today where it was in 2007. So it certainly doesn't end, down 40% from the nearby peak. So it certainly doesn't look like a good deal. Housing markets, market-based or private sector measurements of housing prices are, running down 10 or 20% on an annualized basis. Cash deposits that you're getting are not looking particularly good as interest rates have fallen. Wealth management products that drew a lot of deposit-like flows have shown some real concerns. Like there really aren't a lot of great savings opportunities domestically in China right now. And I think the currency pressure that we're seeing, this is a very normal dynamic in underdeveloped capital markets where, where residents look to other assets, whether it's foreign deposits or hard money like gold to find savings. Ultimately, in a worst case scenario, if you've got the gold around your neck, so to speak, it's saved, and it is not going to be affected by the exchange rate shifts that could occur. And so I think that's we're seeing a rush to gold in a way that frankly is sort of as old as time in China.
And now I want to transition to the lag effects with the Fed keeping interest rates around these levels if they don't start to cut rates. Do you think eventually the consumer, small business, maybe regional banks, are they going to start to feel a lot of pressure, a lot of problems if the Fed keeps rates these high, say for another 9 to 12 months?
I think a big part of why the economy has been a lot stronger than people had expected is because the sensitivity to short-term interest rates has just been a lot lower than has been the case in previous cycles. And that's been a function of a lot of the restructuring of the economy post GFC to reduce leverage and term out debt, combined with the significant money printing and low interest rates that allowed a lot of issuance on the long end at low rates that are locked in. If interest rates were to stay at this, interest rates on the margin are a drag on the economy, but that is a marginal drag, not an acute drag, the way it was, the way such interest rate rises were, more of an acute issue back, say, ahead of the global financial crisis. And the reason why that is because there's not actually a lot of credit creation going on in the economy. Current household and business credit creation is running at the same rate as it would typically do during recessionary environments. And so those interest rates aren't really having that much of an effect. Could interest rates stay at this current level for the next 9 to 12 months without a recession? Absolutely.
But you think, though, that the consumer will start to cut back with inflation and shrinkflation in the real economy, and some small businesses maybe that cater to lower end consumers who have not been benefiting from putting, let's say, millions of dollars in a quote unquote risk free money market fund or short term T-bill and chill, that those sectors specifically, so the economy is becoming more and more bifurcated, would you say, by the Fed keeping rates at these levels?
Well, I think what we're experiencing is an income-driven expansion, and so if you want to understand how different cohorts are gonna live through the current dynamics, and you've got to look at the income growth by cohort. And I think what you see there is that actually lower income folks are experiencing greater wage increases than upper income cohorts, and are translating that into higher nominal spending. And given that the lowest income cohorts primarily do not use credit as a tool because they're locked out of traditional credit systems, their ability to continue their nominal spending is pretty good, despite the fact that rates are elevated. The problem, of course, is that they basically, for every dollar that comes in, they spend it on necessities, which are also rising in price. The real squeeze in the economy is less in the lowest income cohort and more in the middle, where income rises have been more modest, and where middle class households are seeing a squeeze as the price of necessities is rising. Homeowners insurance, auto insurance, things like that. They have enough income to be able to absorb some of those costs, but in their day-to-day, what they're seeing is a shift away from anything that is anything that's a little bit of a luxury, towards basically increasing their spending on necessities as prices are rising. So they're really the ones that are getting squeezed in this dynamic.
So, in terms of sectors or industries, are there any countries or sectors or industries you think that are in a long-term bull market right now, secular one, that will benefit from the way the current monetary policy is, or the way the global economy is setting up right now?
Well, the vast majority of investors are totally underweight uh, commodity and resource related assets. It's because they've been out of favor for many decades. And in an environment where we have deglobalization, rising conflict, and coming on the heels of decades of underinvestment, many of those resource-oriented companies are likely in a uniquely advantaged position on a forward-looking basis. Not to mention the fact that from a pricing or value standpoint, those companies are much more cheaply valued than high-flying AI stocks. And it's funny that in the context of a AI boom, you'd be talking about digging the companies that dig stuff out of the ground and refine it, but that's the way these sorts of market cycles work. The shiny thing that's booming will eventually come to the end, and the overlooked sectors like resources are teed up to outperform ahead.
Well, one of the things we didn't discuss earlier about higher rates is that these longer dated projects, say building a copper mine, which the copper is needed, or baseload electricity is needed for these next generation data centers and other types of technologies, a copper mine can take in many different countries over a decade. And if interest rates are higher, a lot higher than they were a couple of years ago, you're looking at the cost to use debt to build a copper mine. The costs have more than doubled to build, say, $1 billion or more copper mine. And that's only a medium-sized copper mine. So, I mean, the interest rates, I would say the interest rate increases are hurting the supply side for a lot of these commodity producers, especially the longer dated projects like a copper mine or a liquefied natural gas export facility, more than other industries.
Yeah, that makes perfect sense. And it's why, in general, when I think about resources, I often would prefer to hold the product, rather be exposed to the price shifts in the products rather than the companies, because the companies, there's a lot of stuff going on in the companies. Like if you think about gold, I think about gold more than some of the other assets in any detail. But like miners have radically underperformed, the strength in the gold price, and that's part of that is for the reasons that you're highlighting, that load that they have and the price pressures in terms of the costs they have in pulling it out of the ground rising. And so that's why when you're thinking about it from an investment perspective, the squeeze that you're describing, for instance, that you just described with the higher interest rates slowing the ability to create the mines, is bad for the companies and good for the product. So often better to look at the product. And we're seeing CRB move back to basically its highest levels in more than a decade.
Well, also, it's good for existing producers. So if you're a low-cost copper miner
That's
already,
true.
like a Freeport-McMoRan or Lundin Mining or Southern Copper, you're already producing, you're benefiting from that spike in the copper price. You don't have to go out and build a new mine immediately like a smaller company.
That's an excellent point, that incumbents are also benefited relative to new entrants or challengers or those that are expanding. It's an excellent point.
But I've been covering gold miners for about 15 years, and you're exactly right. I mean, like in 2011, the last time gold spiked in a big way prior to the last couple months, the cost for gold mining actually rose faster than the gold price.
Right, and that's one of the challenges is some people think about miners as being a levered bet on gold, but it's not a levered bet on just the top line. It's also a levered bet on the bottom, on the cost side of things. And we've seen it, whether it's in the North American oil production area or both in Canada and in North Dakota, or whether it's related to gold mining. Costs always seem to creep up for the producers when the top line prices go up.
Well, you also have labor costs rising in emerging markets. And then if the gold price spikes, let's say it goes to $3,000, you don't think that a lot of other emerging market countries are going to say, hey, some of our largest investments into our country for foreign direct investments are some of these mining companies. Hey, we're going to increase the royalty tax. We're going to ask for equity in the mine.
Right, exactly. It is always it's always challenging to own the companies versus you can own the physical product and or exposure to the product through financial futures and such, and have less of an issue to those sensitivities. So anyway, that's why I mostly trade the products themselves rather than the companies.
But in terms of the supply and demand fundamentals, you think some of the baseload electricity commodities, so natural gas and coal and uranium, do you see large supply and demand imbalances and increasing demand with supply problems?
Well, I think we have structurally. First of all, of course, when you think about these markets, you do have to be sensitive to every individual market has its own particular nuances and stuff. But look, from basically the summer of 2008 until COVID, commodity prices fell, and they fell by 70% in aggregate. If you look at the CRB index, and that basically basically created a circumstance where there was largely no investment in commodities. Very little incremental investment in commodity production. And as you mentioned, the problem is if today it becomes profitable to, build a new copper mine, we'll see the copper hit the market, 10 to 15 years from now. And so the supply constraints that we have today are a function of the last 15 years of price declines and weak investment. And we're stuck with those for an extended period of time. And demand obviously is much more volatile than that. And, some of the underlying technological innovations require a significant pickup in a whole range of underlying commodities. And so, I've heard, analysts closer, for instance, to the copper market than I am talk about how we might be, 50% undersupplied on copper, if we look out over the course of a couple of decades. And, there'll be innovations and technological innovations that deal with that and some substitution. So the reality will not be exactly what that looks like, but it highlights a sort of structural point, which is there's not a lot of folks who are recognizing that that demand may very well significantly outstrip supply, which was, determined 10 or 15 years ago by the prices at that time, not the prices today.
Yeah, and for copper specifically, it really depends on how many of these next generation data centers, the big technology companies like Amazon, Microsoft, Google, and Meta, they actually build. So they're talking about building these next generation data centers that are an order of magnitude larger and use like an insane amount of electricity with ChatGPT and artificial intelligence software compared to the current data centers. But that's just projection right now. So everyone's coming up with these nice charts that are projections. Until the data centers are actually built, we don't know the exact numbers. They could actually be a lot higher than the projections.
That's right. And I think part of the story, whenever you're talking about commodities, every time people often will try and describe a particular circumstance for a particular commodity driving that market action. Oh, there was, bad weather in Brazil, which is driving orange juice prices up, et cetera. And of course, at any point in time, there might be some idiosyncratic issue with any one particular commodity. But what we're seeing across the whole complex is that there just isn't enough supply relative to the demand. And so that's why we're seeing broad-based. When you see 10 or 20 commodities pushing new highs, that's reflective of the fact that broad-based, we've underinvested in the supply of physical raw goods over the course of the last 15 years. And that issue it's coming home to roost, and the only way for it to resolve itself is through price rationing, since supply cannot come to the market anywhere near fast enough. Which for a lot of these products, essentially the price elasticity, they're totally inelastic. They'll pay any price. If you're building a battery and you need the input metals, you'll essentially pay any price for those in order to build the battery, in order to then build the car or whatever the solar storage unit is. And so, these sorts of commodity prices can create significant, they can have a significant upside skew given the elasticity circumstance with them.
And we're seeing this right now in uranium with nuclear power plant companies, that they were so used to the uranium bear market and buying very, very cheap uranium on the spot market that Kazatomprom was oversupplying the market with, and Cameco had turned into a hedge fund. So Cameco wasn't even doing any uranium mining for years. They were just buying on the spot market at artificially cheap prices with the oversupply and then reselling it on the long-term contract price. Well, now you have supply imbalances. They actually need the supply because the uranium does get used up at some point and has to be stored. Then you have to go and get new uranium supply, and now it's going to take years to bring new supply back online.
That's right. I think probably the main, and we saw this if you go back and look at the '08 circumstance. Obviously, there's lots of other things going on in '08, but it was a moment where across a lot of different commodities, and uranium is one that comes to mind. It was a little earlier than it was like '07, but where you get these sort of upside squeezes in the price action. Which is quite inflationary, and something that these central banks are gonna have to deal with. I think probably the main contrast, which is probably worth at least mentioning, is in the oil market. We do have a lot of supply that's basically been taken off the market as a function of the OPEC constraints and non-OPEC supply coming to the market with the boom in U.S. production. And so, like I said, there's sort of the overall commodity story, and then within each commodity, there is some idiosyncrasies. And so, oil is one of the places where it's sort of the idiosyncrasy is tilted a bit to the bearish side, at least for the time being.
It also depends how quickly new supply can come online for the commodity. So for farmers, there's only a few planting seasons in certain countries each year. Oil companies, if it's a shale well, they can start drilling and have a new well online in 6 to 8 weeks. But a mine is very, very different to bring new production online.
Right. Excellent point. That supply elasticity is, and of course, it's not just it's the time, and then also the cost, the marginal production cost, which to just turn on a little bit more from your shale is a lot easier than building a new copper mine for sure. Or if we get really squeezed, trying to get hard to reach oil, but we're a long way from there. So I think, oil is a place where the boom in supply is probably constraining the price to some extent.
Yeah, and uranium, there's legit supply issues because it could take years to bring on a significant amount of new supply. So that's why there's a squeeze, like you said, and the uranium prices rallied so much the last 9 months.
Yeah, or something like orange juice, where you get freezes and then you knock out a third of the trees in Florida, and like what are you going to do? Like you gotta there's no fast track to growing trees, right? They take exactly the time that they take. They take years to become producing, and so that's that's another idiosyncrasy in terms of slow supply that it's part of the reason why we're seeing a big squeeze in that market as well.
And you can't recycle oranges like you can, say, copper, or scrap silver, or some other type of metal. So
yeah, you can't scrap the oranges. They go stale. That's the challenge with agricultural products, particularly perishable agricultural products.
So I want to transition now, since you worked in the hedge fund industry for the last couple decades. I want to ask you about these leveraged bond trades and the Bloomberg article that came out in April about too big to fail hedge funds. Do you think that there's a lot of these larger hedge funds still that have over leveraged bond trades on? What are they? Their basis trade and risk parity?
Yeah, I think I'd sort of frame the question, or thinking about the question around sort of a broader base view of vol selling that is occurring across financial markets, and hedge funds. You can obviously lots of hedge funds take directional positions, but at its core there is a big vol selling component that often is important to driving the positive returns of funds. And if we look back over the course of the last couple of years, vol selling has been a great strategy, and it's basically permeated everything, right? I mean, how many ETFs are there that have been launched where, what is called income is actually just volatility selling? And I was recently talking with people on Twitter about this, and I was shocked at the number of people who were like, "Well, vol selling is just free money," and it's like, well, it's free money until it isn't, right? You could tell the people who've been around a few cycles versus those that haven't, who have the scars to show that vol selling is not free money, and so I think we're seeing that across a wide range of different investor types, and hedge funds in particular taking advantage of low volatility in many different forms, whether it's squeezing, leveraging spreads or leveraging illiquidity premium or things like that. And that's the sort of stuff that, in a day can reverse quickly and can become a cascading event. And we're probably in one of the riskier circumstances than we've been in a long time when it comes to that, given the buildup in those positions.
So you're saying it could work for years and make enormous profits for a hedge fund doing like the risk parity trade that Ray Dalio came up with the 60-40 modern portfolio theory. Didn't he just leverage up the 40% of the bonds? And he was writing about this for many, many years, that was successful on the treasury part of the bond portfolio, the 40%, that most of the hedge fund managers that copied his trade were over leveraged on the bond part.
Well, I mean, a big part of the risk parity outperformance relative to 60/40 for a period of time was levered bond trades. But a lot of those funds also vary the amount of leverage taking that they're doing based upon what observed volatility is going on. And so as we've seen lower and lower volatility, those funds have taken on more risk, more leverage in order to generate return. And so it's the sort of thing where, if trends in volatility were to swiftly shift, we could easily see a lot of asset selling from those funds. And that's basically, for instance, what you saw just tremors of around the SVB circumstance. I guess,
Early
last year.
2022. Yeah.
Yeah. Where SVB in and of itself, not that big a deal. Some people thought maybe it would be a bigger deal and cause a bigger run, but the big picture story is the 20 or 21st largest bank in the US failing is not like that big a deal. And so, but the market moves, we had a move in 2-year bonds that was, the greatest move since the 70s or something like that. And that's a pretty extreme divergence between those two things. Well, part of the story there is that hedge funds in particular had pretty inaccurate understandings or inaccurate forward-looking assessments of what volatility would look like. So even a relatively marginal circumstance created such a huge shift in asset markets. I think that's reflective of some of the underlying risks that sit in the market that aren't really being talked about much.
Okay, the Silicon Valley Bank, to correct myself, it was early 2023 before the Fed put in the BTFP. But you're saying basically then that these hedge funds that are over leveraged on the bond trades that Bloomberg was writing the article about back in April, they could get caught off guard if there's, say, an unexpectedly large move in credit spreads or bond yields then?
Yeah, I mean, basically, think about credit spreads. We're basically at, the lows, multi-decade lows in credit spreads. If you're a fixed income manager, fixed income hedge fund who basically in one form or another takes spread risk. They can talk about a lot of idiosyncrasies, but the basic picture is they take spread risk in one form or another, and you're seeing equities go up the way that they have. The only way to generate the kind of returns that you need to generate is through more leverage. So they've taken on a lot of leverage. Well, what's leverage? Leverage credit spread positions are effectively short volatility positions. And so these things interact with each other and feed on each other, where the leveraging up of the credit spreads is by somewhat definition creating lower observed volatility in the short term, but creates a lot of risk of reversal in the long term. So you look at something like credit spreads and you're like at, the 8th percentile of credit spreads. The last time this happened at roughly this level was 2007 and 8. And I'm not saying we're going to have a financial crisis like that again because the banks aren't nearly as levered, but what ended up subsequently happening, the repricing of risk that ended up subsequently happening certainly was not a good experience for the vast majority of funds.
And that last crisis, that was residential real estate. I think the regional banks, the insurance companies, the pension funds were starting to see a lot of evidence of this with the FDIC reports and other research reports from consulting company looking through the financials of the regional banks. The commercial real estate problem, I don't know on timing, but I know it's bad. Do you think that it's going to continue to get worse going forward?
Well, the main contrast of the commercial real estate issue today relative to where we were with the residential real estate problem in 2008 is that it's mostly on balance sheet lending versus which is marked at book, rather than securities purchases by banks, which gets marked to market. And so the banks have a lot of flexibility to be able to let those issues take a long time to play out. And if regulators are complicit in the amend and pretend style approaches that the banks may take towards those loans. This is the sort of thing that could get dragged out for an extended period of time. I mean, I give the example, CRE loans for banks today are probably earning about 300 basis points of NIM, give or take for most banks, maybe a bit more than that, on the ongoing cash flows. And they're only taking 25 basis points of charge-offs. So you got like 275 basis points in the black on those positions. Now, we all look at each other and we say, well, that's, the market, if we were to mark that to market, you'd be losing a ton of money. But from a cash flow perspective, from the bank's perspective, looks positive to them. And if it takes 10, 15, 20 years to play out, then we will have long forgotten long forgotten SVB by the time that those losses get taken. The most important thing is when it comes to on-balance sheet loans for banks, bankers, the best thing that bankers are good at is restructuring bad loans. They're not making loans. They're not good at making loans, but they're very good at restructuring bad loans. And so we're likely in a long-term amend and pretend. Losses will happen, but we're likely in a long-term amend and pretend on it.
That's interesting. I mean, we'll see what happens. I've spoken to other hedge fund managers that are short a lot of this stuff, so we'll see what happens. I'm thinking a lot of regional banks are in serious trouble, but if they don't need to raise capital, I guess they don't have to mark to market the losses.
Right. That's exactly right. Is that as long as the regulators give relief, they can extend it a long time, and it's also important to recognize that there's a lot of the commercial real estate market which is a lot more boring than shiny office buildings in central business districts. A lot of commercial real estate out there is like faceless medical buildings that you go to visit your general practitioner, or the gas station that you fill up your car at. Or self-storage units or all that stuff. So it is worth mentioning that the problem, someone may say, well, there's trillions of dollars of commercial real estate. I mean, the reality is the core part of it that is really at risk. You're talking about a substantially smaller number than what sort of the headlines might suggest.
And I think they also lump multifamily in there too. So those are apartment buildings. I mean, they're technically not residential since they're not single family homes.
That's right. That's right. Depending on exactly who you're talking to or what data you're looking at, multifamily often is included, and sometimes multifamily construction loans are included, which is it's just a different risk profile than a Midtown Manhattan shiny office building that no one's going to anymore.
Well, I really enjoyed our discussion today, Bob. I think one of the major points here is our listeners should pay attention to the 10-year US Treasury yield. And if the yield continues to go up to 4.7 or higher, that would probably be a headwind for stocks. And if it stays at these levels at 4.289% or goes lower, that would probably be a tailwind for US stocks.
That's exactly right. The global asset markets are driven by that bond yield, and it used to be every day the first thing you do when you woke up and looked at the markets was to look at the stock market, and these days it's wake up and look at the bond market. So that's the area of the market to keep focus on.
So if my listeners want to check out your exchange traded funds or limited funds, how did they do so?
If you want to learn more about our financial products, check out our advisor site, which is unlimitedfunds.com. And if you want a sort of ongoing flow of macro-related content that you mentioned at the top, definitely check out on Twitter, which is at Bobby Unlimited, and also have a YouTube page of various clips if you're more into listening than scrolling through Twitter, and that's also under Bobby Unlimited.